how do you calculate the safe withdrawal rate for India? Unfortunately, when we first started thinking about this problem, there was no study which calculated this rate for India. We were mostly importing whatever was the international convention of 4%. My first research in 2022 was when we computed this rate. It's publicly available. You can take a look at this research. And what we did in this research was, first we looked at historical data, because the way you calculate safe withdrawal rate is you look at what the markets have done historically. Now, unfortunately, this is a bit of a problem for us planners in India because we don't have much data, right? So Sensex data, 1979, that's when Sensex data is available. So that's a proxy for equity returns. Debt, we have used from 1979 to 1994 fixed deposit rates, and post 1994 there is availability of liquid funds, debt mutual funds. So we have used liquid fund returns post that. So we are able to arrive at a continuous debt index, reconstituted debt index. Essentially, we are looking at 40 to 50 years of data. Now, when Bengen did this analysis in the US, he actually had 100 years of data, which made his job a little easier, because he could really look at a century of financial data to try and estimate what the withdrawal rate will be. Now, this limited data in India presents very, very unique problems. So let's take a look at why that's an issue. First is, if we are looking at a typical retirement exercise where somebody retires at 60 and has a life expectancy of 90, so we are looking at a 30-year retirement period. So what you can do is, starting from 1980, you can take different 30-year periods to examine how asset prices behaved and to examine what would have been a withdrawal rate which would have ensured that the retirement corpus does not go to zero. So you only have 12. So from 1980 to 2010, that's the first retirement period or path. So similarly, I did this study in 2022, so I stopped at 2021. So 1991 to 2021, that's the last full period. 12 is too small a sample for doing a systematic or a rigorous study. So I extended the range beyond 2021, and I used projected data for the balance years. But when I was doing this, I was cognizant of the fact that in no retirement path should the projected number of years be more than the actual data. So I stopped at 2006 to 2036, because in that particular instance, you actually had 16 years of actual historical data, and you used 15 years of projected data. So this is the safe withdrawal rate that was arrived at for each of those retirement periods. This looks fantastic, right? 4% withdrawal rate looks small, right? You can see in the early years, people who retired way back, they could even enjoy an 8 to 9% withdrawal rates. Withdrawal rates have come down, but even if we look at recent withdrawal rates, it's still comfortably over 4%. So based on this data, you couldn't fault somebody if they were using an aggressive withdrawal rate of 5 to 6%. However, we are, I think, we need to answer the question, are we overestimating, the withdrawal rate? So let's look at why the previous analysis is a bit of an issue. If we look at asset returns in India, be it equity or debt, it's been falling. So I think that's been a structural decline in asset returns in India, right? So when you are using historical data, which is actually showing a structurally declining return, you are actually overestimating the safe withdrawal rate, because today's generation and the next generation is not going to earn those returns. Now, there are various reasons that we can hypothesize why asset returns have been falling, but the most obvious answer is that Nominal returns are falling because inflation has been falling, right? So whether real returns have been falling or not, that's a different question. But the headline nominal numbers have been declining because as an economy, we are no longer inflating at the same rate as 1990s or 1980s. We are now a much better handle, on inflation. But essentially, this is a problem. Now, many times when I have tried to position this data that asset returns have been falling, there is generally a counter view that as long as you're a long-term investor, you will still make very, good returns. That's not really true, because even if you look at a 15-year holding period for Sensex, it still shows a very consistent declining trend. So we have baked into the analysis that asset returns are declining because they are, declining. Now, we looked at, okay, so now, the problem statement before us was that we cannot use returns from 1980 onwards because those returns are super inflated. So what returns can we use? So we looked at decadal growth in returns. So we looked at how has the equity market done in different decades, and we looked at how the debt returns, has done. And a very interesting picture emerges. It appears that around the year 2000, there has been a structural break in these asset series. So you can, if you take pre-2000 data, that's the high return period. Post-2000, that's the low return period. If you look at the debt returns, it's a similar story. Debt returns prior to 2000 was high. Debt returns after the year 2000 was low. Even if you do test in statistics of time series data, you will get that there has been a structural break, in these data around the year 2000. And I think that's got to do mostly with, how inflation itself has actually shown a structural decline and a structural break between post-2000 era and the pre-2000 era. So essentially, we restricted ourselves to data only post-2000. So we deleted all the data pre-2000 and are only working with post-2000 data because we think the post-2000 data is more representative of the era that we are living in and potentially is more representative of the data or how things will pan out going forward. But this is a huge problem. We are already working, we started with around 40, 50 years of data, which itself is a problem. Now we are truncating that data to only about 20 years of data, which is even a bigger problem because now you don't have even one single 30-year period to analyze, right? We don't have actually even one, such retirement path for analyzing. So we don't have an option but to use, simulation. Bengen could get away without using simulation because he could actually carve out multiple retirement paths from his historical data. We unfortunately don't have, that liberty. So for simulating equity returns, what we did was we took the past 20 years data. When you are doing a simulation, you need a distribution from which to simulate. So we looked at how equity returns have done, and we fitted a normal curve on it. Of course, a normal distribution will underestimate black swan events. So you can see how the actual data shows a much longer tail on your, on your right-hand side. But the fitted normal distribution actually shows a much, smaller tail. So that's what we refer to when we talk that, normal distributions don't account for black swan events. But the curve, is a pretty good fit. If you do a test of normality, it shows a pretty nice fit. So we use this. We did random sampling, 10,000 simulations of monthly equity returns. So we generated different equity returns. And this is broadly the output that we got. 35% of the times, the safe withdrawal rate is below 4%. So anybody who actually is using a 4% safe withdrawal rate runs a 35% probability of exhausting their retirement corpus earlier than anticipated. And that's a huge risk to take with your retirement corpus. 8% of the times, the safe withdrawal rate is below 3%. So if you're using a 3% rate, the probability that you will not be safe is as low as 8%, which I think is a decent risk to take. And if you want to be ultra conservative, the safe withdrawal rate is below 2 points. If you use a withdrawal rate of below 2.6%, you pretty much have a negligible chance of actually exhausting your retirement corpus before your life expectancy.